Now, at the start of their story, Anahita and Martin were both self-employed as well as investors. And Anahita and Martin lived in the same neighborhood as Abhishek and Maya. And on the surface, their financial situations looked the same. Anahita and Martin were slightly older. They were in their mid-50s, and they had worked hard for years in their print shop. Because they had bought into the neighborhood, that is, they had bought their house in that neighborhood earlier than Maya and Abhishek, their value in their house, their equity value in the house, rose dramatically. And 15 years ago, they had also bought 2 3-bedroom houses as investment. And the value of those houses had also gone up quite a lot. For a long time, Anahita and Martin felt secure. They had high quality positions in their houses, and they always spent less than they made. They also had about 60 lakhs in the form of mutual funds, gold securities, bonds, and fixed deposits. These safe investments gave them about 10% of average returns. Their line had always been slow and steady. Eventually, however, they started feeling like they were working too hard. If they didn't show up at their print shop, no work got done. And they felt that they were in a bind. If they had created these jobs for themselves, that they couldn't afford to hire someone else to do. Also, in their industry, technology was advancing very fast, and their print shop was in danger of becoming obsolete. The 2 rental houses were valued about 3 crores each in the current market. They were rented out at about 75,000 each and had an underlying cost of about 30,000 per month on the remaining 2.5 crores of debt. And so they produced a cash flow of about 45,000 every month. Anahita and Martin's current monthly statement was earned income of 5 lakh of rupees and passive income of 90,000. Their expenses were house mortgage 40,000, living 1 lakh of rupees, and taxes of 1 lakh and 35. Where were Anahita and Martin, and where did they want to get to? Anahita and Martin were still self-employed, and they wanted to get out. Could they do something new with their business? They were aware of the trend towards self-employment at home. With many newly self-employed workers, surely they felt that there would be a need for added services. Internet, printing, binding, secretarial, even conference rooms for holding their meetings. Anahita and Martin had an idea. Why not combine a set of executive suites with several conference rooms and a receptionist and lease them out, while also offering the amenities of an on-site technological print shop? Anahita and Martin were cautious though. They didn't want to rush headlong into this new venture. They thought they would feel more secure with an alternative source of income to cover their income. They wanted to explore possibilities with their business, not sell out. What they needed was passive income. So, analysis of Anahita and Martin's financial statement. Anahita and Martin eagerly compiled the financial data in order to analyze it. They could be slow to move, but they were always open to learning. So, how much did Anahita and Martin keep? Their total monthly income was 5,90,000, less their total monthly expenses of 2,75,000. The difference is how much they kept, which was 3,15,000, which was a percentage of 53%. Did their money work for them? Their total monthly income was 5,90,000. Total earned income was 5 lakhs, and their total passive and portfolio income was 90,000. The percentage of passive and portfolio income was 15%. What was their income after taxes? Their total income per month was 5,90,000. They paid taxes on that of 1,35,000. Their net income per month was 4,55,000, which meant they paid 22.88% on taxes. How much did they spend on housing? Their total housing cost was 40,000, which was about 9% of their net income. What was their return on assets? Their total assets was about 6 crores. Total passive and portfolio income was 90,000. And so their cash on asset return on an annualized basis was just 2%. So how wealthy were they? Their total assets was 6 crores and 65,000, and their total expenses was about 2,75,000. So they were 242 months or more than 20 years wealthy. They could survive more than 20 years if they quit their jobs, but they would have to sell assets. Anahita and Martin's 5-year plan. Anahita and Martin were surprised to learn how low their return on assets was. They hadn't fully understood the impact of a changing real estate market on their investments. Now more than ever, they were determined to seek changes in their business, and they were open to looking for advisors to help them. So their 5-year plan was to sell their highly appreciated rental properties and reinvest the money for a more reasonable return on capital. They wanted to maintain a substantial security fund. Their goal was to have 6 months of living expenses in reserve, including the cost of mortgage on their new investment property. They wanted to look into expanding their business. They wanted to assemble a talented team of advisors to help with each of the above objectives. So how did they do? How did Anahita and Martin do? Because of the need for security and passive income, Anahita and Martin decided to assemble the real estate portion of their team first. One agent specializing in residential home in their area and one specializing in medium-sized income-producing properties. They learned how to maximize real estate deals through tax-deferred arrangements. This would allow them to sell their property and look for a replacement property within a specified time. So as long as the new property's price was equal to or more than the price that they got from selling their previous property, and all of that money was rolled into the new property, they would pay no tax on the new property, on the capital gains. In fact, taxes on the sale would be deferred till the new property is sold. After both leases expired for the current tenants, Anahita and Martin worked out an arrangement whereby the tenants would stay on a month-to-month basis at half the rent, and they could show the property on short notices. Anahita and Martin quickly found buyers for their two homes. After all expenses, they would net about 5 crores and 45 lakhs. Not wanting to pay the taxes on that windfall, they sought out a tax replacement as soon as possible. So as soon as they accepted the offer on the rental properties, Anahita and Martin started looking out for new properties. With the help of their real estate agent, they found an apartment building and purchased it for 14 crores. The apartment building would give them a net cash-on-cash return of 17% for their 5 crore 45 lakh investment. This would yield a cash flow of around 92 lakhs. The payments were 7,72,000 per month, and according to Anahita and Martin's agreement, they would put 6 months worth of payments in secure investments. They sought out a financial planner to help them identify the best investment vehicles. The planner also recommended some other opportunities. As a result of his help, for example, Anahita and Martin began a variable whole life insurance policy. This form of insurance offered them a guaranteed death benefit and accrued cash flow. It allowed them to allocate a portion of each premium payment to one or more investment options. Now, Anahita and Martin could take advantage of many different mutual funds and thus combine investing with tax-free growth. Finally, Anahita and Martin were able to put their dream in place. They spent 2 years and 50 lakhs investigating the possibilities for the new business. They had a few setbacks along the way. The most notable one was their first business consultant. He was a well-spoken man with a lot of good ideas, but he did not follow through on his ideas. It took some time before Anahita and Martin learned their lesson. Choose advisors who speak from their experiences, not from opinions. The next advisor had a lot of experience taking businesses public. He helped Anahita and Martin identify their niche and future possibilities. Anahita and Martin searched high and low for the best location for their business. And eventually they found space to lease, and 3 years after the idea was conceived, they opened their business as a limited company. Acting on advice from a management consultant, they developed their operation in such a way that their presence wouldn't be required every day. At the beginning, they worked very hard, but most of their time was spent in developing operations manuals that would allow them to have somebody else run the business for them. It took 2 years before they started seeing profits, a delay that their well-designed business plan had forecast. Because they had planned for delayed profits, Anahita and Martin had the reserves that could see them through the first years. After 5 years, the business was producing 15 lakhs of passive income every month. Their presence was no longer required for the business to operate. Their passive income from real estate had grown to 10 lakhs per month. So how wealthy had they become? Their total assets was 2 lakh and 75,000. Their total expenses was 9 lakhs and 75,000. It would appear that Anahita and Martin were just 137 months or 11.4 years wealthy. However, their passive income of 21 lakhs 70,000 was more than their total expenses of 9 lakhs and 75,000. So they were actually infinitely wealthy. Their assets were working for them and they didn't need to work. So what's next for Anahita and Martin? Anahita and Martin look forward to the day when their business can operate without them going into work every day to check up on things. Within the next 2 years, it should be turning that corner. Currently, they're leasing their business quarters, but the owner has expressed interest in selling it. Anahita and Martin lease 1/4 of the space in that building. If they owned it, the lease from the other tenants would more than cover their own payment for office space. Thanks to their advisors, they know that a limited company should not directly own real estate. So they plan to form a private limited company to hold the property. In a sense, the limited company would buy the real estate and the private limited company would own it, receiving rent from the limited company. Anahita and Martin have moved themselves out of self-employment and firmly established themselves as business owners and investors.